Good morning, everybody, or good afternoon, depending on where you are. My name's Jeremy. I'm with the with LMN, and Greenie is here, and we're thrilled everybody could join us today. Here we have Mark. He's going to be leading our masterclass this week on crew budgeting. Glad everyone could make it, and Mark, we'll let you take it away.
Great. Thanks, Jeremy. Welcome, everybody, to this week's masterclass on crew budgeting. So this week, we're going to talk about crew budgeting, why they're important, how to create one, and I'll take some questions at the end if you've got any specific to this topic or anything else. So ultimately, the crew budget, the reason that we want a crew budget is we want to really create some alignment between everybody in the company so that each crew is actually contributing to a successful year for the company. And each crew can be measured on their own in the sense that each crew can get credit for the work that they do for the company. And so we want to make sure that we've got a motivated team in the sense that each crew sees themselves as their own little sort of component of the business. And what we want to do here is we want to make sure that each crew gets the opportunity to kind of have their own sense of purpose, have their own goals, their own responsibility to this budget, but they've got some freedom to kind of get that work done in the way that they see it being most efficient so that they can grow revenue and contribute to a successful year for the company. But more importantly, really understand exactly how they're doing individually. And so I think when crews understand for themselves how much money they're generating for the company, how much their total payroll costs, and how much their equipment and materials cost, and what the overhead looks like, I think they begin to understand the way the business works a lot better. And therefore, I think they can contribute a lot better, but also understand how to unlock their own true potential themselves. And so for field crew supervisors and people on the crews, I think it's important that they understand what they need to do in order to unlock future wage increases or even, potentially bonuses if the company is considering using a bonus structure. So we want to make sure that that opportunity is really clear. And that's ultimately, I think, one of the big outcomes from having crew budgets is that the opportunity is clear for the crews, but it's also clear to the owners who deserves a raise, when they deserve a raise and why, and also, when a bonus is due and how much that bonus should actually be if there is a bonus program in the company. So the ideal here is we want to create as much opportunity as possible, and we just want it to be very transparent so that it's super fair and so that decisions and conversations in the business become a lot more rational and maybe kind of take the emotions out of things. We want to make sure that we're compensating people fairly for the work that they're doing in the business. And the only way to do that is to really understand how much revenue that crew is actually producing to contribute to the company outcome. And so as we kind of move forward, the basis of a budget is really nothing more than setting a goal. And so before we get into the actual budget, I just want to talk about SMART goals for a minute. So SMART goals are goals that are very, very specific in nature and they are measurable. And so this is, setting a revenue goal, but it's also setting expense goals for each crew. And so if you kind of look at it like money in and money out, that's kind of the easy way to look at it. We're actually setting goals for how much money we expect a crew to bring into the company and how much money they're allowed to spend to produce the work. And so we're setting some SMART goals by creating a budget. So they're very specific. They're measurable because we're going to use the revenue dollars and the expense dollars to measure them. And then we're going to set a goal that's achievable, one that we're comfortable that the crew can actually produce. And we're going to make it really relevant because when we create a crew budget, we're creating a budget that is so specific to that crew that they're able to really move the needle And I think what happens when people set high-level company revenue goals and they share them with the whole company, it gets hard for each crew to understand how they're contributing to it and how things are actually performing. And so it's really relevant when you create a crew budget, because it applies to that crew and they have full control over it. So that makes this a very relevant goal. And then time bound for a crew budget, it's always set for the entire year. And so we've got a timeline, and we can break that down into a monthly goal so that there's a production target or a revenue target for each crew each month. And that becomes very time bound in the sense that I know what my goal is for the year, and I know how much revenue my crew should produce each month. And now this goal starts to feel a little bit more realistic and attainable. And so again, they create transparency and allow us to create a much better way of paying staff in the long term. So, and what I mean by that is we can set the base pay for crew leaders and the crew people according to the revenue that they produce. So a crew that is a bigger revenue producing crew has an opportunity to make more money. And that's only fair. You can think about it this way: as if they're going to produce more revenue, they should make more revenue for themselves in the process. And that's what crew budgets really allow business owners and business leaders to do, is actually pay for performance. And so crews that are very experienced and very capable should make a little bit more money than others. And crews that may be a little bit less experienced, they're going to have opportunity to get more money as they produce more revenue. And so it becomes, I think, a very fair way of paying people. You're getting paid based on what you produce. And I think I've said this many times, everybody in the world is an entrepreneur. Just because you have a job and you decide to go to work in a company doesn't mean you're not an entrepreneur, because every day you get out of bed and you go to work for yourself. You go to work to support your family and your personal needs, and unlock the potential of you as a person. And that makes you an entrepreneur. And I think when you have a crew budget and you work in a company where they recognize your actual performance and they pay you based on your performance, you get to be an entrepreneur, and you get to do that within another company. And I think that's a pretty amazing thing to be a part of. So crew budgets are really a game changer in the sense that we create transparency. We pay people fair wages based on their skills and their effort and their outcomes. And that gives more opportunity to make more. And it allows us to even get into or consider a transparent incentive program. And that's a company by company decision, but having a budget, a crew budget, allows you to actually talk about incentives and wages in a transparent way. So what is a crew budget? Very simply put, a crew budget is really just a set of goals. We're going to break that down into a monthly production target so that you know exactly how much revenue your crew should be producing. And then we're going to have expense budgets. And those expenses that the crew is in control of are the labor, material, equipment, and in some cases subcontractors, but much less frequently. Usually the expense budgets that really impact the crew are labor, material, and equipment. And that's kind of obvious why, because the crew leader manages the labor, material, and equipment to get the projects done. And so if they're managing those three major buckets very efficiently, then they are going to save money while producing revenue. And so if they're really efficient in their day-to-day operations as they get the work done and they're spending on labor, material, and equipment, then and only then is there, a profit. And if they're not efficient, then, it could be actually spending more money to produce the work than the company's even charging. And so it's very important that the crews understand what the production targets are, what the expense budgets are, and then we've got an opportunity to make a profit, and maybe even a little extra profit, to the point where maybe there could be an incentive plan in the company that is tied to some sort of a production bonus. So they're super foundational components to setting goals. And ultimately, the outcome, the big outcome, and sort of the exciting thing for employees of landscape companies is often this opportunity to get paid for, your actual efforts and your actual outcomes. And so a couple of examples that I like to share sometimes so that people really understand how amazing a crew budget can be for everybody in the company, for, the owners and leaders in the company, the crew leaders, the crew people, and, ultimately even the customers that are getting our landscape services. First off, we can set fair wages using the budget. So what this means is, we can answer a lot of questions day to day. And when planning a business, for example, if, the owner decides to increase the sales goal at the company level or on a crew level, they can quickly sort of understand how much budget they have to actually hire staff. And this is an example, this 25%. Every company has their own field labor ratio. We kind of call that a magic number. But 25% is kind of an industry standard. So this is a safe number for conversation purposes. So if a crew or a company had planned to grow revenue by $200,000 and the field labor ratio is 25%, which means the company spends 25% of every dollar that comes through the door on the crew that's actually building or maintaining or installing irrigation or doing arborist work, whatever your company specializes in. And so that field work, just doing the tasks out in the field, not the people that work in the office, but just the people who are actually doing the physical work day to day, typically that's going to be about 25% of the top line revenue. So in this case, you'd have $50,000 to pay the staff that are actually doing the hands-on work in order to generate that $200,000 in revenue. Because there's so many other expenses. We've got trucks and we've got all kinds of overhead costs and the facility management and phones and insurance and uniforms. And we've got materials to buy and all kinds of different equipment, maintenance and repairs and insurance. And so the list is endless of expenses. And so if we spend any more than 25% producing the revenue on the field labor, it's almost impossible to make a profit. In fact, many companies lose money if this ratio gets to be much higher. So the magic number that we're kind of going to talk about today is 25%. Every company has their own, every crew has their own, and it's up to the leader of the company to kind of set that ratio on the company budget and share that with everybody in the company so they understand what that magic number is in your company. Now, we're going to set fair wages using this budget. And the way that we do that is we actually just take the wages for an individual and we apply that ratio, and it tells us how much revenue they need to produce as an individual. And then we do the same for a crew. And so if you think about it like this, a person that makes $65,000 as a field worker with a 25% labor ratio would actually need to be able to produce $260,000 worth of work in order for the company to pay all the overhead costs, pay them their wage, buy all the material, pay for the trucks, and still make a small profit. And so this becomes a really important component of setting wages. So when we look at a crew looks like this. We've got a field supervisor wage of, let's say, $60,000. And then we've got two crew people. And let's say they're each at about $45,000. So that total crew is actually costing the company $150,000. Now, if we apply that ratio of 25%, that crew would actually have to produce $600,000 in revenue in order to pay that wage, pay all of the other expenses, and still turn in a small profit for the company. Now, how does this sort of work in getting raises in the future? So if you are a field crew member or a supervisor, when we take that wage and we go to increase it, now you saw a minute ago we were at $150,000, or sorry, 140,000, and the total crew wage was 600. Now when we jump over and we go to increase that wage, now we've got $170,000 to pay the crew, which means the revenue has to go up. So we take that same calculator of 25%, and now the crew production goal has shot up to $680,000. So in order to give a $20,000 raise to that field crew foreman or supervisor, we have to actually get more revenue. And this is kind of motivating in the sense that crews begin to understand if they eliminate waste and they turn all of that waste, all of that downtime into productive work, and they can produce more revenue, then they can earn more money. And so unlocking your next $20,000 raise as a foreman relies upon increasing the revenue that your crew can actually produce. And I think that is a big sort of alignment tool in the sense that business owners and their field crew leaders understand in the same way that when revenue goes up, wages go up. And I think that's important because now you can have rational conversations about how much you get paid as an employee. You can approach your business owner and ask for a raise with a business case. I deserve a raise because my crew is producing more revenue versus I want a raise because I think I should get a couple more dollars an hour because I'm short on cash, right? It just doesn't resonate with the business owner who's trying to balance profit and treat everybody fairly. And I think once there's this common language, everybody gets really clear on the fact that, you know, the priority is to produce more revenue so that everybody does better, so that the field crews can actually unlock opportunity to get better wages and better outcomes for themselves. So what I'm going to do here, I'm going to jump into a different tab here, and I'm going to run through a budget and show you how this actually happens, because it sounds great, a crew budget, but you know, maybe it sounds kind of complicated to some of you. It's really not. LMN has a very simple budgeting tool that makes this, you know, somewhat complicated financial conversation simple. Kind of puts this into layman's terms, if you will. And so we're looking at a crew budget example here. I'm going to roll through it. I'm going to try not to take too much time, but I'm also going to try to explain each part in detail so that you can create your own crew budget. So first off, on this budget info page, this is our first page. So I'm going to just click this tab over here. I'm going to just go down under the work breakdown based on the type of crew that I'm putting a budget together for. Now, this is an install crew. You can see up top, it's an operating budget for an install crew. So because it's an install crew, I'm just going to go down to the work breakdown here, and I'd update this and say that we've got 100% of the work is going to be from install. Now, the reason that's so important, as we get into the budgets, we're going to talk about some benchmarks, and those benchmarks are actually benchmarks against other crews. And so what we want to make sure is that this work breakdown is correct so that we're actually benchmarking your expense ratios against other install crews. That way it's going to be very, very accurate as we start to build your budget and compare it to not only the other crews in your company, but all of the other crews in the industry. And so as we roll through this budget, you're going to learn for the first time as a crew leader or as a crew member how your crew actually is going to be performing against every other crew in the industry. Maybe not quite every crew, but we do manage about a quarter of the crews in the industry here at LMN. So sales budget for this specific crew, how do we put that in? Very simply, we're going to click here and we're going to, in this case, we've just called it installation revenue. We could break that down further. We could add another work area. And maybe what we're going to do is we're going to say, well, this install crew does some soft landscaping. So we could say softscape and we could say hardscape, and we could create a few categories. Very easy here. We could, oh, I missed a forecast there. So I'm just going to put a few dollar amounts in there. I could save this. Now, maybe I want to add even another. Maybe I want to say, well, this crew also does a lot of landscape lighting. So I could add lighting. Any categories that you'd like to add. Maybe last year we did 50,000 previously, and this year we're saying, I think we could do 80,000. Now, certainly I have to rely on the sales team to go out and get that work. But this is me saying, as a field crew supervisor, this year I think I'm going to be able to do a little bit more than I did in the past. And so last year, my softscape revenue, we'll just say, was 300,000. And now this year, I'm saying, I think I'd like to do 400,000. My hardscape revenue last year was 200,000. And this year, I'm saying I'd like to make that 250,000. And my lighting revenue was 50,000, and this year I want to make it 80,000. So what I'm doing here is I'm just looking at the previous year's breakdown, and now I'm forecasting some growth. And so you can see up on the top right here, it's actually saying right now that I'm predicting a 32% increase in revenue. Now that's a pretty big increase to think that I'm going to get that much more revenue without maybe adding more labor or something changing specifically in the business. Now, certainly we can sell some more profitable work, and landscape lighting is a really good one because there's a lot of revenue produced in a short period of time because it's expensive material. It could be, maybe on the hardscape crews, you're capable of installing really expensive materials like flagstone, and maybe that's why it's going to go up. And so sometimes it's not about getting more labor. Sometimes it's about doing more of that work that just produces more revenue. And so in many cases, if we're predicting higher revenue and a much bigger growth curve, like 30%, we have to ask ourselves, how are we going to get more revenue? Is it going to be by eliminating waste? Is it going to be by installing more expensive materials? Or are we going to add more people to the crew so that we can get more work done each day? And it's usually a combination of all three. And, business owners are very in touch with this. They're trying to sell work that's higher revenue producing. They're trying to eliminate waste, and they're trying to do all the work without putting too many labor hours into it. And so what the crew budget's doing here is kind of aligning the business owner with the field crew leaders so that they're seeing the business the same way and they're talking the same language. And this makes doing business a lot more fun. I think being a field crew leader without understanding how the business really makes money can be a little frustrating, and it can start to feel like work without purpose. Where when you understand how the business actually generates a profit, and when you understand that your pay can be linked to your outcome as a crew leader or as a crew member, it really starts to be a little bit more motivating, because when you get out of bed each day, you are going to work for yourself. You're out there to eliminate waste and turn that into revenue. You're out there to help the business make better decisions about what equipment you should be using to do the job so you can get more work done each hour and produce more revenue. And when you do that, it's not uncommon to see these types of numbers. It's not uncommon to see 30% revenue growth on a crew if they've optimized equipment, if they've trained their staff really well to perform the work, if they've eliminated all the flow interruptions and created a lot of waste elimination systems and processes. And when all that waste is gone, you just produce more money. You produce more money for the company, but you produce more money for yourself. And that's the purpose of a crew budget, is to really find that happy sort of efficiency level in the company where everybody earns more. So crew budgets are about everybody earning more. And that's, I think, the beauty of this level of transparency. So I'm going to keep rolling through this budget. This is our sales budget. And again, if this is your first time setting a budget, you're going to need some help. This is something that the owner and the finance leader in your company can help you with. But ultimately, what we want to do is we want to set a really realistic plan for revenue for the coming year. It has to be realistic, because if it's not, and we set the expenses to a budget that is too optimistic, then we might fall short and we'll overspend all year and end up actually losing money, because more money is going out than coming in. And so it's very important that this number is attainable. We can't create goals that are not attainable. That's part of the SMART goal setting system. Now, next up, the field labor budget. When this is the exciting part, this is where the rubber kind of meets the road for the crews, this is when you start to really understand exactly how much money you're spending as a company or as a crew on labor. And so when we on the labor budget, this little labor burden number has to get updated first and foremost. So labor burden, this is surprising sometimes for employees for the first time when they start to really understand the financial side of the business. The labor burden is the money that your company is sending to the government on your behalf. And these are taxes that you don't actually pay, but that the company pays because you work for them. And so this could be many different types of taxes depending on what state or province or region you live in. But basically what this is government taxes that the company pays on behalf of the employees. And so it's not the payroll deductions. This isn't the stuff that comes off of your pay. They also submit that to the government on your behalf, but the company also pays tax just like you do every week on your behalf. And a lot of times employees don't understand that. But about 20% in most places of your pay, actually you submit 20 to 50% to the government in taxes, depending on where you live. But then the company also puts another 20% to the government. And that's what fuels the countries that we live in. So it's incredible how much tax is embedded in the day-to-day payroll. This is kind of a shock many times for people when they first do a budget. In fact, many employees think, oh no, why is this a company expense? That's coming out of my check. It's not. This is another check that the company writes in addition to the money that comes off of your check. So kind of shocking the first time you see it. But when you think about it, I'm just going to show you this crew, and then I'll show you how much actually ends up going to the government. But just look at this. If the company pays the staff $152,300 for this crew, they're paying the government $27,414 out of their pocket, and the government is also taking their share out of the employee's pocket. So of this 152, the government's going to take some of that as well. So the government's got their hand pretty deeply in our pockets here on field labor. There's no doubt about that. But it's important that you understand that these expenses are all embedded in the company expenses. And when we go do these projects and they sound like big ticket items, like it sounds like a big number when you go do a $30,000, $40,000, $50,000 job. But the reality is there's just expenses layered on top of each other far beyond what most field workers understand. And so I just want you to be really clear on what these expenses are, because they impact how much the company can pay you in your role. And it impacts everything. So let's add a few people into this crew now. The crew budget is designed with just the people on this crew. So the crew leader is already in here. And so there's one crew leader in this case. 2,000 hours, and this is the number of hours that you're going to work in a year. And so this is very simply dictated by, if I'm going to work 40 hours a week for 50 weeks a year, it's 2,000. If I'm going to work 40 weeks a year for 50 hours, it's still 2,000. And so the simple math here is, how many weeks are you actually going to be out working, and how many hours do you plan to work each week? And then if there is any overtime, how many hours do we expect the overtime to be for the year? And then up here, we just put a little overtime multiplier. So if you do get paid overtime and there are expected overtime hours, we're going to add those here and the multiplier up here. Now, the average wage, we're going to say, well, this crew leader's wage is $28 an hour. And we're going to say, if this crew hits this number this year, and again, your company may or may not have a bonus in place, but if there was a bonus in place, what would typically happen is you'd say, if you hit the $730,000 number and the jobs came in on time, you got all of the jobs done within the hours, and there's usually a little plus or minus there. One job might go over by a few hours. The next job might go under by a few hours. All business owners are reasonable. There's lots of up and down on jobs. There's rain and weather and tough customers and people in the way and late material deliveries. Things happen. But ultimately, there's like this plus or minus. And what that plus or minus is estimated versus actual hours. And so when you're using the LMN Crew app, you can see how many hours were bid for the job and how many hours you've taken. And so if on every job, the jobs are coming in on time and you hit the sales goal for the year, you can unlock a bonus. And so very simple. Every company's going to have a slightly different bonus calculation, slightly different program. And not every company has bonuses in place. But I can assure you, if your company is trying to get crew budgets put in place, they're probably thinking about some kind of an incentive or bonus program as well. Because any business owner that's looking to create transparency and really drive pay per performance culture, they're typically willing to do a bonus if you can actually deliver on this crew budget. And in many cases, they'll even pay a higher bonus if you go higher than this budget. So hey, if you did more than $730,000, your bonus could be significantly more than $10,000. I'll leave it at that for today because we're not here to talk about bonuses, but it's in the line here for a reason. We're going to factor that into the budget. And if you hit the sales goal, then and only then can we pay a bonus. We can't pay bonuses in businesses when the sales goals aren't met because we haven't made enough profit to pay a bonus. We can only do that when we hit the sales goal. And that's the key thing to remember when creating a budget like this. So when we go to add the laborers, here we've got 2 laborers. So we're going to say there's 2 laborers. They're going to work 1,800 hours per year, 100 hours. Average wage is $19. Their bonus is going to be $4,000 if we hit the sales goal. And now when we add all these people up, they come up to this total here of 152,000. We've got the burden, which again was the government taxes. And now we know that our total field payroll is 179,000. And now if you look up on the top right, this would tell us how this crew is actually comparing to the industry standard. And this is pretty important for you if you're a crew leader or a crew member. This is your chance to see, hey, based on what I'm getting paid and the revenue that I'm producing, how does that compare to every other crew in this industry? And so here, this labor ratio is a little bit on the low side compared to the industry average by 1%. And that's not much. 1% is very, very little. So what I would say here is this is in line with the industry average. So it's really strong. But what I might be able to say is, well, hey, you know what? I think I could probably, if we got this extra sales, because we did increase the sales this year, I think I could actually pay everybody a little bit more money. And this is a rational conversation now between the business owner and the crew foreman. And the way that I would do this is I would say, well, based on last year's sales, you were really close to 730. So I think I could actually pay you based on this. Now, if you came and told me that you were going to do $1 million this year, I would say, great. If you do $1 million, I'll give you a great bonus. And next year, I'll set your base pay higher because now you've proven that you can do $1 million. But we can't just keep putting the raises up until we see the proof, because otherwise, as business owners, we could be really putting the business at risk. If we paid everybody way too much money and then didn't hit the sales goals, there'd be no business at the end of the year. So, but what I would say in this case is I'm pretty comfortable that this is a reasonable sales target. So I'm going to say, I think I can give a raise, and I think I can take the supervisor's base pay up. And look what happened there. I got the ratio to match the industry average, which still very healthy. And look, now we're paying this crew leader $4 an hour more. And again, this is really rational math. And this is an opportunity for business owners and field crew supervisors to feel like business partners. And that's how it should be, really. Because when you run a crew, you really are running a component of the business. And so you should see yourself like a business partner. You get out of bed, you go to work for yourself, you're an entrepreneur, you're running a crew that produces revenue within the company. So why not start to have financial conversations and talk to each other rationally? And in this case, it's very justifiable to pay that crew leader more money. And I always say the crew leaders they have the most difficult job in every landscape company. They have to manage the customer experience. They have to manage the employee experience. They have to train those employees. They have to look after the equipment. They have to look after the material. They have to make sure things are safe. They have to make sure that all of the information is being collected accurately and submitted to the office every day so that billing is accurate, payroll is accurate. It's a tough job. And so I want to pay those field crew supervisors really good wages, but I also want to see them as partners, because ultimately they carry my wallet. If I own the business, the people that are out there actually producing the work, they make the decisions on how we do the work. They make the decisions on what equipment, what material. They make all the decisions around efficiency. And that's a really important job. And so I want to make sure I pay them as much as I possibly can, but it has to be rational. It has to be tied to a business plan, because I got to keep the lights on for everybody. And so this budget allows for a much better conversation with field crew supervisors, because they now understand why there's a limit to how much they can earn, but they also understand how to raise the limit. And that's really important. If you're a crew supervisor, know how you can raise your wages by contributing more to the company. That's the key here. So I'll move on now to the equipment budget. And again, there's an opportunity here for you as a crew leader and as a business owner to actually look and say, like, what could we add to this crew this year that would allow them to get more work done in less time? And so this is another business conversation instead of an emotional conversation. Now you can say, listen, I know that we could get a lot more work done on this crew if we had some specific equipment that we don't have today. Now, you can see this crew has a crew dump truck, an excavator, a skid steer, and a trailer. And maybe there's one that we'd like to make bigger, a bigger skid steer, a bigger excavator, or maybe we want 2 excavators. Maybe we want a 5-ton and we want a 2-ton. Maybe you want track wheelbarrows. Could be anything that you're looking for to get more efficient. Now, what happens in most businesses, they sort of talk about this and maybe they do it, and maybe they buy too much equipment, and then they're suffering from, too much expense on the equipment side. But I think what happens a lot of times is crew supervisors don't get the chance to say to the owner, hey, listen, I think I'd really like to spend a little bit of money on my crew to buy this or lease this new piece of equipment. because it's going to raise revenue and it's going to improve efficiency. And I know it's going to actually allow us to get more work done in less time. And that's going to be a win. And so this equipment budget allows that conversation to happen and happen really meaningfully. When you create this budget, set all the equipment in the budget that you think would be best for the coming year. And so an example here, I would say, well, what we're finding on our crew right now is we're really struggling to get all of the excavation work done fast enough. So I'm thinking I want to add another excavator. And so if I said I want a 2-ton, maybe the top one is the 5-ton, I'm just going to go into the system. I'm going to type that in. I'm going to say it's leased. And I'm going to get a lease payment from the local dealer. And let's say that lease payment comes in at $1,260. And we're going to make 12 payments. So I'm just going to go ahead and add that. And now that comes into my budget. And you can see now up top on the top right, it's actually telling me that I'm going to spend 10.6% of revenue that my crew produces, but the average in the industry is 13%. And so I want to be able to kind of look at that and say, well, you know, what else could I spend? And this is healthy, believe it or not. Sometimes, you know, this conversation is uncomfortable for some, but when you start looking at it this way, you're saying, well, what if I did spend a bit more on equipment? Would I actually be able to produce more revenue? That's kind of the decision maker. And so maybe the crew dump truck is, you know, a little too small. And so maybe what I'd say here is, well, I'd rather get a bigger crew truck and invest a little bit extra there. So what I could do here is make a change to that. I could just simply go in and say, well, you know what, we're going to upgrade this truck and we're going to go buy a $150,000 dump truck. And if we did that and we put that over 5 years and it's worth, say, $55,000 after 5 years, and we've got the 12 payments each year, and let's say the interest rate on that equipment is 8%, I'm going to add that in now, and I've upgraded my dump truck. And it's a little bit more money. And now look, my ratio went a little over the top. Now I'm, 13.9% on an average of a 13. But I'm going to live with it. I'm going to say, you know what, my equipment ratio is a touch high, but I think it's going to make all the difference. When I've got this bigger truck, I'm going to be safe. I can pull bigger loads. I can put bigger loads of dirt on it. I can fit 6 skids instead of 3 skids, whatever it happens to be. And so I'm going to make my decision and put this business case forward as the supervisor of the crew. Now, the only other things on the equipment that I have to think about are how much fuel does my crew need for the year? Well, maybe that's going to be a little bit more this year. So I might bump that up. I'd think about the repairs and the insurance. And again, these are usually numbers that the finance department and the owner helps fill in the blanks, because field crews are not necessarily equipped with that information. And so this is where a little help comes into play. But the field crew should be saying what equipment they want, and they should be putting a business case together for why they want it. Is it actually going to produce more revenue for the crew? Because if you've got the right equipment and you can get more work done each day, it's going to be easier to hit that sales number or exceed that sales number in the coming year. So once the equipment's all in and we're comfortable with this ratio, which we're starting to creep up there a little bit because we bumped up the fuel and we bumped up the crew truck, now we're going to kind of look through the rest of the budget and decide if we can actually afford to do this. So we're a little over ratio, but not too much. It's still pretty healthy. So we're going to move into the material budget next. And again, this is one where the business owner and the finance department usually actually helps set what this number is for each crew. It's usually a percentage of the work that you're doing. It's generally falls within a percentage. And the way that the company figures that out, they look at last year and previous years, and they see how much, what percentage of revenue was being spent on material. And that helps them set this in the budget for the coming year. So again, this is kind of a financial metric. Many times, this isn't something that a crew leader would be expected to just come up with on their own. The labor and the equipment, we really want the crew leaders to craft. The materials, one where the company should tell you what the budget would typically be. So if the industry average here for this type of work is 30% and this company's 17.8, something's not right. And so when it lights up red, we have to think about that. And so the reason this is in the red right now is I increased the sales budget when we got started, but I didn't increase the forecasted materials enough to support that. And so what I'm going to go ahead and do is make that change here. And so I'm going to say, based on last year, what were we spending? And so what should it be in the coming year? And so I'd say, well, last year we spent 28%. And so I'll put in a number here that I think is going to get me close to that. Here's 26%. And I might say, well, you know what? This year, I think because we're doing more expensive pavers, more expensive flagstone, more expensive plants, I think I can actually keep the cost of the material lower, but charge more for it. And so I'll justify this as a business owner and then hand that off to the crew. Or maybe I'll say, yeah, you know what? 26% is a little tight. Maybe I need to bump that one up a little bit, and I might take it up to 210,000, for example, which might just be a little bit more realistic. And you can see when I bumped it up, this turned green because the system is saying it's a lot more reasonable budget. Maybe everything's going to go great and it can be 26%. And let's try to do that by being smart about how we manage materials and by really getting as much markup on those materials as possible when selling and estimating projects. But this 28% is probably more realistic. So I'm going to leave it there. Next up, subcontracting. Some crews actually manage subcontractors every day, all the time. And so sometimes this comes into play. Not very often. So we're not going to put anything in the subcontracting budget here because most crews don't carry subs with them every day and pay them as part of their team. And so we're not going to include that in today's discussion. The next major area that we would cover would be the overhead area. Now, overhead in a company is unbelievable. It's shocking to most people how much overhead there is. And if you're an employee of a company, I like to often explain this, like, think about your own paycheck. When money comes in, there's just so many things that you need to pay for at your house or where you rent. It could be your utility bills. It could be, the phone bill. It could be you want to fertilize the lawn and you got to buy some fertilizer. It could be the mortgage payment or the rent payment. The list is endless. And so what happened, that's all kind of overhead if you look at it that way. It's kind of like your cost of living. Well, overhead in a landscape business is kind of the cost of living as well, if you look at it that way. These are all the things that we need in our business to keep the lights on. This is like the facility, and this is marketing and internet and phone bills and insurance and uniforms and all the things that don't ever really end up getting charged to a customer. And you can imagine there's a lot of things. This is like all of the things that happen in the business day to day for the business to be there, not the expenses to actually perform the work, like the materials and the staff that are out building gardens or maintaining properties. So in every business, there's a lot of overhead. It tends to sit around 20 to 30% in most companies of revenue. And so that's a lot of money, but think about it. Where do the office staff get paid? Where does the owner get paid? Where Does any delivery truck drivers or mechanics, if you have any? All those people are overhead because we don't charge our customers directly for them. We charge our customers to produce projects, and then we still have to pay for all of these expenses out of the money that's generated from those projects. And so this overhead piece is really important and often overlooked by field crews because they don't see all these bills or they don't think of how much all of this adds up to be. So overhead is a massive expense in most businesses. It's usually almost as much as the crews that go out and perform the work when you think about it, because there's just so many things. So your number in your company is going to come from the finance department or the owner, depending on the way you're going about budgeting. Whoever is helping you with the budget is going to tell you exactly what that number is in your business. And so again, I increased the sales, but I didn't increase the overhead. So I got to go back in here and I've got to bump that number up now to get it more accurate. So this crew, as we produce more revenue, is going to be contributing a little bit more to overhead. And so I'm going to bump it up a little bit to 150 and say that's still going to keep us just under the acceptable average for a company of this size, or with these types of crews, sorry. And so now what I'm saying is this crew is actually going to contribute $150,000 toward the company overhead to pay for all of those expenses that exist in the business. And then when I get down to the next line, it's going to tell me how much profit this crew can produce for the company. And this is really important. First off, nobody in the world wants to work in a company that's not profitable, because companies that are not profitable have no money to invest in training. They have no money to invest in equipment. They have no money to do the right thing for customers day to day. They have no money to actually do marketing. They have no money when there's, sort of a rainy day or an accident, a dark moment in the business to cover those costs. And there's definitely no money for the owners. And it's no secret, most businesses, 80% of small businesses go out of business within their first 4 years. In this industry, the average profit is only 2 to 3%. The average business owner is only making around $60,000 a year. And so you may think that the numbers are a lot better than they are. And when you see profits, it may seem like they're huge. In this case, a $730,000 crew is going to make 10% profit, which is $75,000. And it sounds amazing. But the reality is we need that money in the business to reinvest in the business so that the business continues to grow and continues to evolve in a healthy way. So we're investing in infrastructure. We definitely need some of this so that we can pay bonuses. We need this so that we can invest in training, so that we're getting better as an organization, so that we continuously improve. We're going to use some of this money just to cash flow the business day to day. It's unbelievable how much cash flow sucks up out of profit. When we're making profit, we're using it to pay for the next job, because we're always buying materials and we're always paying for equipment. We're always paying those overhead costs, and we got to make payroll. And so we need this profit to maintain a healthy business. And without it, there is no business at the end of the day. And so profit is not a dirty word. And owners sometimes are afraid to tell their staff how much profit is made, because they're actually just worried that it gets misunderstood and that they think that there's some incredible outcome that is being held secret. And I think in the process, when business owners can't share what the profits are openly, that's when that secret exists. But the reality is, in most cases, there's nothing to hide. There's not some incredible amount of profit. There's just a good, healthy profit that keeps the business healthy for everybody in the company, for the owners, for the staff, and for the customers, so that the business can do the right thing, continue to improve, and operate in a healthy way day to day to be great. Great companies need great profits. And so ultimately, the idea behind doing these crew budgets is to really just align and understand that this profit is needed. And when we get this profit and when we grow revenue, we have this opportunity to then pay our staff a little bit more money just by aligning. And so that's the big outcome that we're hoping for here in this exercise. Last, I'll just touch on very quickly, this analysis page at the bottom allows you to get a view on your crew and see what the actual potential of your crew is. And so there are a couple key things here. Every crew has some expected unbilled hours, which means, we have to get to the yard in the morning, get our stuff on the trucks and get out of the yard as quick as possible. And then we have to drive to the site and we have to drive back from site. And that's usually 15 to 20% of your day, which is unbilled. And so we want to calculate that into the equation here. So if it were 20%, I'd just put 20%. But what this does is it changes all these metrics on this page. So we want to know if we're going to work a 10-hour day, is 2 hours spent loading and unloading and driving, or is it just an hour and a half? That's how we want to look at this. And so we want to be really accurate with the unbilled hours. But what this then does is, if in this case, this crew, if our labor charge out rate was $70 per hour, based on the number of hours we have available in this crew, this tells us that this crew is actually capable of producing as much as $816,000 worth of work. And so this is like a health check. The crew is big enough to produce $733,000 or $730,000. We have enough hours to produce that revenue. And in fact, if every hour was accounted for and we only spent 15% on unbilled, this crew could produce $816,000, which for you as a crew leader is really motivating, because what this is saying is, hey, there's still more capacity for my crew. I could produce even more than $733,000. Open up an opportunity for maybe a bigger bonus and a higher wage next year. And this is where you get the opportunity to actually put a business case in front of your owner and say, hey, listen, we're having a rational conversation here. I want to get more in the future if I can produce more in the future. And I think that'll be a welcome conversation. Every business owner wants to help their employees untap their true potential in business, because that's, ultimately how they untap theirs. And that's, I think, a true alignment. So next up, I'm just going to kind of jump back over to the closing slide here for a minute, and I'll take some questions after that. So if you haven't heard, we've been probably emailing you and letting you know, next week is our Landscape Mastermind Summit. We would love to have you. We're going to talk about all of the things we talked about here and many, many more. Hopefully you can join us down there in Orlando. It kicks off next week. Lots of education, lots of social networking. We've got an incredible award ceremony with some huge prizes for everybody in the company. There's even some amazing employee prizes with some incredible trips and whatnot for the winners of those prizes. We would love to have you down there. There'll be lots of speakers. All of our LMNers will be there to help you use the software. If you want to learn how to do this in person and work with somebody, we'll definitely have people around that can help with that too. But hit the QR code there, and hopefully you can join us next week down in Orlando. I'll take your questions now.
On stage. So we did have a couple of questions come through for you whilst you were presenting there. So first off, Cody had one for us here. So what was being shown earlier, that those budgets were based on a 12-month budget and not a 6-month, correct?
Yeah, I mean, that budget was it's not really a budget based on months. It's a budget based on the season. So in this case, it was an install company that would work 8 months a year doing install.
Fantastic. And we actually had a couple great ones come in from Carrie Shea, one of which was, how do you create a sales budget for each crew if you have multiple crews?
That the budget dictates that, because the size of the crew and the amount that you're going to spend on paying that crew, if you use the field labor ratio, it'll tell you how much they need to produce. So if you had a crew that was costing you a total of 200,000 and you had a 25% ratio, you're going to use that as your multiplier. And that's going to tell you that the revenue actually needs to be 800,000 for that crew. So setting the production goal is directly tied to the expense, the total labor, and your field labor ratio target.
That's great. Now I see Thomas also had one here, and he asked whether crew budgets are they standalone and in addition to the annual snow or install budget, or do they somehow integrate?
Yeah, so generally, if you've got crew budgets, they're standalone, but they roll up to the company budget. So the company will have one budget for the entire company, and then any major revenue generating department or crew will also have a budget. And those all roll up to the company budget, because ultimately the company is just a sum of all of its parts. And so each crew has a budget, and the snow department might have a budget. So let's say you do snow 8 months a year and you've got 10 crews. We're going to take those 10 crews plus the snow budget, and that should equal the company budget. And so that's how we like to look at it.
Perfect. This is a great one from Michael from our friends at Nokomis Landscaping. So in terms of looking at the budget as a P&L statement, where would the equipment budget be, i.e. from an accountant's point of view? Is the equipment budget simply just profit?
The equipment budget. So sorry, I don't think I quite understood that part about the profit. Can you just repeat that question?
Certainly. So his question was, in terms of looking at the budget as a P&L statement, now where would the equipment budget be? So if, for example, from an accountant's point of view, would the equipment budget simply just profit? And again, I didn't know if maybe you had better insights.
I think I know what he means. So the equipment budget in the LMN budget, what we're trying to do is assign the equipment that the crew uses to their budget so that we can assess the profitability of that specific crew. In the accounting world, when they look at your entire equipment list for the year, they're going to depreciate that equipment and do all kinds of funky things to reduce the tax exposure. And that's a completely different exercise. So what we're doing here is just saying, here's the equipment that the crew is going to use. Here's what it's going to cost us. And we're just looking to make sure that it's not costing us too much so that we don't make profit. Equipment and tax accounting is a completely different topic. So we'll just maybe kind of leave it at that.
Sounds good. There's a couple more here. And Erica asked whether the payments on equipment, are they already factored into the profit, or does it have to come off the net profit as it's a balance sheet item?
Equipment payments, again, we're talking about a crew budget versus a company profit and loss. So they are sort of two different things. But generally speaking, equipment payments are just expenses, and they come off before you calculate profit, just like our budget. So we're aligned with the P&L in that sense.
That sounds
you pay for your equipment, it's an expense. Profit is what's left after you've paid for your equipment, just to be really clear on that topic.
Sounds good. And this is actually a great one for Fred, and we could leverage your experience. Now, do you think a 50% gross margin is still a good target for this industry based on the current market and the economy?
Yeah, I think 40 to 50% gross margin is an ideal target, and there's a range there for a reason. Different types of work have different types of gross margin, and so 50 is a great target, but on certain types of work, sometimes that gross margin comes down to 40%, and it can still be very healthy. A lot of this is dictated by your overhead. And so larger companies tend to do larger projects because they have lower overhead and they can work at a lower gross margin. And so generally speaking, if the gross is between 40 and 50%, there's a lot of opportunity to still be profitable. So it's largely dictated by your overhead in your own company.
That's awesome. So, Mark, I know we're already at time, and in usual fact, we're at 9 minutes over there. So I'll leave you to parting words there. And for anybody else, as the moderator here, and if you might have some questions in chat that we didn't get the chance to address for you today, we're going to be working with our support teams to reach out to you just in case there's any questions to go forward. And we'll move from there, and I'll leave it in your capable hands, Mark.
Yeah, and always feel free to reach out to me on LinkedIn or Instagram. On LinkedIn, just search Mark Bradley LMN, and on Instagram, it's just Mark Bradley 360. So feel free to hit me up there. I'm usually online daily. I usually fire answers back pretty quickly to questions. So feel free if you've got anything that you'd like to talk about there. Anytime, just hit me up. But thanks for joining, and tune in next time. We've got the weekly program coming up here in a couple of hours, so hopefully I see you again soon. Thanks again.